Retail earnings in Q2 were absolutely abysmal, but there were 4 key things that we learned with this round of earnings. And I'm going to compare those lessons to 3 exceptional retailers in this video. So stay tuned. You're watching More Money. Let's get it. What's up, guys, and let's get right into this. So Barron's put out an article recently where they discussed 4 key items that they learned from the recent retail earnings releases, and I couldn't even say it better myself. The first thing that we noticed is that the consumer is split into 2. So many retailers that are catering to low-income customers are warning that those customers are actually struggling with record levels of inflation. However, notice that the higher income customers are actually doing better. And I believe the reason why this is because I believe that inflation impacts the different socioeconomic groups differently. Because if you have a lot of income, less of your income is going towards the things that have been increasing in cost substantially. For example, the price of fuel. The other thing is, those people that are generally higher income could potentially be those people that are sort of like white collar, that are still working from home. So they're not even having to drive to work. So in fact, they're probably saving money from even being able to give up their cars. And so that's just one example. But effectively what I'm trying to say is that a higher proportion of a lower income person's income will go towards the staples like groceries and fuel and transportation than those people on the higher income scale. And so they can shield more of their income from the ravages of inflation by putting it into the stock market or diversifying into other areas. And so they're not going to feel it as much. And so they still would have more disposable income, which is what we're seeing in this environment. Now, slightly related to the first point is that shoppers aren't scrimping on beauty. And I would assume that the people who spend a lot of money for beauty products aren't at the lower socioeconomic scale anyways. And what I mean by that is people who pay for expensive sort of products. I know that when I was broke, I was not spending money on expensive toiletries or anything like that. But now that I have a little bit of money, I do splurge a little bit. So I understand this from that perspective. So it looks like from this article that people appear to be sticking with their skincare routines that they adopted during the lockdowns. And if those habits hold, they're saying that beauty retailers' sales could actually lift. And that brings me to a big theme going into 2023, which is personal care and sort of like luxury items. I'm really looking into more and more of companies in that space because I do believe that there's quite a few names in that area that have been unnecessarily been beaten down. And stick to the end of this video because I'm going to present one of those names to you. The third thing that we learned is that margins are still under pressure. So notice that many retailers like Target, Gap, Urban Outfitters are struggling to keep inventories under control and were recording margin pressure. And I was actually just reading the Q1 2023 release of Canada Goose, the Canadian winter jacket manufacturer, and even they're experiencing margin pressure, not necessarily on gross profit margins. Those actually went up in this environment because they produce a lot of stuff locally, so they don't have issues with supply chains, but they're taking it when it comes to SG&A pressures. And so even retailers that are not having inventory problems and are not having supply chain problems are still facing operating profit margin pressures in this environment. And so what does this all mean? Well, we're in an environment right now where interest rates are continuing to increase and people are believing more and more in what the Fed is saying, that they're going to continue to raise their rates. And so what does this mean for the second half? Well, that's our fourth takeaway here. Retailers are bracing for a tough second half. So although we are in a decline, I would say that this could actually be an opportunity to add an exceptional retailer to your portfolio. And I got 3 to show you in this video. So the first one that I want to talk about is actually Best Buy, and they reported their second quarter results. Notice that comparable sales actually declined by 12.1%, but also notice that they still managed to be profitable in Q2 of their fiscal year 2023 with GAAP EPS of $1.35 a share. So that's quite exceptional. And they said that they expect comparable sales declines of around 11% for the year. And I personally think that they're forecasting to the best of their knowledge where they do believe revenue is going to end up at the end of the fiscal year 2023 for them. But I also want to add in a margin of safety here because the economy is deteriorating. And so you can see from my model that the Patreons have access to is that I have a feeling that their guidance might actually be a bit strong. Not from the perspective that they're overstating it, just from the fact that they just don't have the data to back up the fact that the economy is deteriorating at a rate faster than any of us are actually seeing right now. And so I've actually taken down their revenue by 15% in 2023, and I expect 2024 and 2025 to be a bit of a slog for them, and so it's only recovering by 5% a year. And so what does that mean for my valuation? Well, you can see that using a terminal multiple of 15 times earnings, I'm valuing them at approximately $120 per share. So the current share price opens up a bit of an opportunity where it's trading at approximately 60% of its intrinsic value. Now, I'm not going to go into the cash secured put opportunities for those, but if you want to know what a good cash secured put opportunity for Best Buy is, jump onto the Patreons, because I do have a cash secured put options tracker tool where I put what I think is a good options opportunity for Best Buy in this environment. Now, the next retailer that I want to point out to you is Walmart. Notice that they actually are struggling in terms of gross profit margins. However, they do expect that to get fixed in the back half of the year. Notice I'm increasing their revenues by 4% for 2023, or their fiscal year 2023, and 3.5% thereafter. So nothing crazy overall, just growing at the rate of the economy, or just slightly a little bit faster than the rate of the economy overall. But I do believe that Walmart in the current environment is slightly overvalued because I think there's a rush to quality, especially with this stock right now. So I'm valuing them at approximately $100 per share, and they're currently trading at $133 per share. So I believe that the share price is reasonably valued to slightly overvalued in this environment. But this leads me to my thesis about high-end luxury retailers in this environment. I think some of them are being overlooked. Here's one that you don't want to miss out on, or at least don't want to miss out on, at least considering for your portfolio, because it's never actually advice on this channel. Talk to your investment advisor to determine what's right for you. But you can see here, I actually was recently looking at Restoration Hardware. That's the RH to the top left. And I do expect their 2023 fiscal year revenues to decline, and 2024 to not be that good, and 2025 to only be a marginal recovery. But overall, into the medium to long term, I expect them to grow at a healthy 10% a year clip with strong gross profit margins. And so where exactly do I see my valuation for Restoration Hardware in this environment? Well, first, I do want to remind you guys that approximately 80% of the viewership of this channel comes from people that are not subscribed. So if you have an opportunity, please hit that red subscribe button. And let's dive right into their valuation. So you can see that using a low terminal multiple of 15 times earnings, which I actually think is very low, I'm valuing this company at approximately $500 per share. Compare that to their current share price of $270 per share. This company's trading at approximately 53% or 54% of its intrinsic value. And this is also a company where Berkshire Hathaway has taken out a $460 million position into the name. And so there is something to this investment, and I highly encourage you to look at the model that I've provided for the Patreon. So the question is, how do you get access to that model? Well, you can get access to that model at the lower tier of the Patreons. And if you want to join us for an epic live presentation, you can join us at that higher tier. Now, the way that I talked about Restoration Hardware in this video was very high level, but I actually do a very deep dive. And so as you start considering Restoration Hardware, or if you want to learn more about the company, click into this video where I do a deep dive into the name, and that link is right here.